Hi everyone! So today's video is about a company I'm pretty sure you already know, Xiaomi, the brand that went from cheap phones to a full consumer tech ecosystem. Alright, let's get into it. Xiaomi's story starts software first. The company is founded in 2010 and the first real product is MIUI, a customized Android layer built around a simple idea. Ship updates fast, listen to users, and build a community that feels involved in the product. That's the seed of a fanbase Xiaomi still benefits from today. Then, Xiaomi turns that software traction into hardware. In 2011, it launches its first smartphone, Mi 1, with a clear playbook, good specs for the price, and a distribution model that leans heavily on online demand generation. The next key step is 2013, because that's when Xiaomi begins building the ecosystem. Smartphones become the hub, and a growing layer of connected devices starts forming around it. Around the same time, Xiaomi expands down-market with Redmi, which becomes the volume engine next to the main Xiaomi brand. From there, Xiaomi globalizes. A clean early example is 2014, when it enters India with an online-first playbook, the same pattern again. Internet distribution, sharp pricing, and fast scaling if demand is there. Then you get the capital markets milestone. In July 2018, Xiaomi lists in Hong Kong, and the company becomes a public platform story with a permanent funding base. The modern inflection point is 2023-2024. In October 2023, Xiaomi upgrades the strategy to human x car x home and launches HyperOS as the software layer mint to unify the ecosystem. And in March 2024, Xiaomi executes on this new leg by launching the SU7, making 2024 its first year of deliveries and ending the year with 137,000 vehicles delivered. And all of that, the expansion, the diversification, shows up in one place, the revenue curve. On this chart, you can see how fast Xiaomi scaled. Revenue goes from 66.8 billion RMB in 2015 to 365.9 billion RMB in 2024, roughly 21% CAGR over the period. And the 2025 cadence is still strong. H1 2025 revenue was 227.2 billion RMB, plus 38.2% year-on-year, driven by smartphone recovery, continued IoT growth, and, most visibly, the ramp of the Smart TV AI segment. In Q3 2025, revenue was 113.1 billion RMB, plus 22.3% year-on-year, supported by the same mix, with EV remaining a meaningful incremental contributor. Xiaomi is often described like a smartphone company, but that's not the right mental model. The simple way to see it is Xiaomi is an ecosystem company. Hardware is the entry point, but the long-term strategy is to connect everything. Human x car x home with a unified software layer, HyperOS, so the phone becomes the remote control for your entire tech life. And Xiaomi is explicit about the philosophy behind that. Amazing products, honest prices. They even made a public pledge that the hardware business net profit margin won't exceed 5%, and if it does, they return the excess to users. So the model is not maximize hardware margin like its competitors, it's closer to use hardware to build scale and loyalty, then monetize the user base through services and an expanding device portfolio. Xiaomi frames the business around a smartphone x AIoT core, and now a second bucket for smart TV and other new initiatives. And within that core, the economics are totally different depending on what you're selling. Smartphones may see volumes, but structurally lower margins, 12.6% gross margin in 2024. IoT and lifestyle, a mix that's improving with margins moving up, 20.3% gross margin in 2024. Internet services, the real profit engine, 76.6% gross margin in 2024. So the flywheel is basically ship hardware, grow users and devices, expand services monetization, reinvest into products and the ecosystem. And the scale is real. Xiaomi highlights 702.3 million global MAUs at the end of 2024. Now you can actually see the model evolving in the revenue mix. In 2015, Xiaomi is phone-heavy. By 2024, it's more balanced. Smartphones are 52% of revenue, still the biggest line, but no longer everything. Internet services are 9%, small in mix, but disproportionately profitable. The rest is largely IoT lifestyle, which keeps expanding as the ecosystem grows. That's the setup for the margin discussion later. Services can lift gross profit even if Xiaomi keeps spending heavily on product and new initiatives. Smartphones are still the entry point for the ecosystem. So here is the competitive landscape in one chart. This market is highly fragmented, the others bucket is huge. But Xiaomi still manages to be number 3 globally, with 13% market share in a brutal, hyper-competitive category. And that's not bad at all. Xiaomi's edge starts with something simple: trust on value. The low-profit hardware logic reinforces the brand promise of good specs, fair price, and helps explain why Xiaomi keeps a loyal base even when the cycle turns ugly. The second layer is the community-driven loop. Xiaomi has spent years building a Mi Fans culture where users don't just buy products, they give feedback, report issues, and push feature ideas. And Xiaomi positions that as part of how the brand evolves. And the third layer is ecosystem lock-in, human x car x home. Once you own multiple Xiaomi devices, switching costs rise. The phone becomes the hub, and the ecosystem becomes stickier as the device footprint expands. Over the last decade, gross margin trends up. Product mix and segment economics are improving, with a step change in the last few years. But EBITDA tells a different story. It's volatile and choppy, because gross margin is only the first layer. The second layer is operating expenses, and Xiaomi actively uses them as an investment deal. You can see that in R&D. In 2024, R&D rose to 24.1 billion RMB, plus 25.9% year-on-year, explicitly linked to smart EV and other new initiatives. And the other big lever is selling and marketing. In 2024, it increased to 25.4 billion RMB, plus 32.1% year-on-year, driven by higher logistics, sales force compensation, and promotion advertising, with the EV push in the background. Now let's move to EPS, and before you read it, one technical point matters. The share count changed a lot over the period. The weighted average number of shares went from roughly 9.7 billion in 2015 to 24.8 billion in 2024. So per share, progress can look flatter than the business evolution. And when you look at EPS, the message is consistent with what we saw earlier. Xiaomi isn't a high profitability story. It reinvests heavily, so EPS doesn't compound smoothly, it stays relatively flat and choppy. One important outlier is 2017. EPS turns negative mainly because the year was distorted by a big pre-IPO accounting item which hits below the operating layer and doesn't reflect the underlying run rate. And if we extend the curve with that latest prints, the jump is obvious. H1 2025 basic EPS was 0.9 RMB, plus 143% year-on-year, and Q3 2025 basic EPS was 0.47 RMB, plus 114% year-on-year. This is partly real operating improvement, but management also highlights that headline earnings were amplified by fair value gains on investments, which can be volatile. That's why they also report adjusted net profit 21.5 billion RMB in H1 2025, plus 69.8% year-on-year, and 11.3 billion RMB in Q3 2025, plus 80.9% year-on-year. Now on the balance sheet, there is nothing special to point out. The financial structure is very healthy. Xiaomi ends 2024 in a clear net cash position. Now, capex. Xiaomi isn't a factory-heavy industrial company. A lot of manufacturing sits with partners, and Xiaomi invests more selectively, so capex stays relatively light as a share of revenue. On free cash flow, the takeaway is similar to EPS. There isn't a smooth compounding profile. Free cash flow is very volatile because it's driven by profitability, but also by working capital swings, especially inventory and payables, which can absorb or release cash from one year to the next. That's why you get a negative print in 2022, then a sharp rebound in 2023-2024, when operating cash generation improves again. In 2025, Xiaomi's new initiatives became much more concrete. Management raised its 2025 EV delivery target to 350,000 units, and shortly after did a large Hong Kong share placement to fund business expansion and R&D, including expanding the store network and accelerating international retail rollout. On the product side, Xiaomi expanded beyond the first EV model. In June 2025, it launched the YU7 SUV, positioned directly against Tesla's Model Y, with reports of 200,000 orders within minutes of pre-orders opening. Xiaomi also suggested the Auto division could potentially turn profitable in the second half of the year as scale improves. And in May 2025, Lei Jun said Xiaomi would invest at least 50 billion yuan over 10 years into developing in-house chips, centered around the X-Ring 01 smartphone processor. Now look at the regression chart. This is where you really see the re-rating. The stock was range-bound for years, and then from late 2024 into 2025, you get a near vertical move. And my takeaway is simple. That move isn't fully explained by the EPS curve alone. A big part of it is narrative. Xiaomi getting priced as an EV plus ecosystem story, plus the renewed push into in-house chips. So the market started paying for optionality, not just trading earnings. And you also have to put that in context. 2025 was a better tape for China equities in general, with sentiment recovering across big Chinese names. So Xiaomi benefited from both the company-specific story and the broader China rebound. Then, from around September 2025, the stock cools off. And that looks like a normal digestion phase after such an exponential run. At today's price of roughly 35.5 Hong Kong dollar and using my financial year 2025 adjusted EPS estimate of 1.87 RMB, the stock is trading at roughly 16.8x PE. So to wrap this up, Xiaomi is a pretty unusual model. Thin margin hardware used as a distribution engine and monetization through the ecosystem, especially internet services, which is where the group structurally earns its highest margins once the installed base is big enough. What's impressive is execution and product market fit. Xiaomi isn't just shipping devices, it's building a brand and a community with management known for fast iteration and listening closely to users. When that loop works, new launches tend to land well and the ecosystem keeps expanding. 2025-2026 added a new narrative layer, EVs and in-house chips, and the product perception seems strong enough that even Ford CEO Jim Farley publicly said he's been daily driving a Xiaomi SU7 for months and doesn't want to give it up. On valuation, my takeaway is simple. At today's price, the stock looks reasonable for a company of this quality. With this kind of brand strength, ecosystem optionality, and what I think are very strong long-term prospects. Thanks for watching this deep dive until the end. If you found it useful, feel free to like, subscribe, and share.